In this video, we will explore about financial securities, specifically looking at product definitions and terminology within the Indian securities market. We are going to break down the major types of financial instruments available to investors. Broadly speaking, we can categorize these into four main groups. First, we have equity, which represents ownership. Second, we have debt, which represents lending. Third, we have hybrids, which mix features of both equity and debt. And finally, we have commodities like gold or oil. Let us begin by understanding the first category in detail. When we talk about equity shares, we are talking about buying a fraction of a business. If you hold equity shares, you are essentially a part owner of that company. These shares are issued by companies or legal entities and are purchased by both large institutional investors and individual retail investors like you and me. The primary way these are issued is directly through stock exchanges. It is important to know that this entire process is strictly regulated by SEBI along with other bodies under the Companies Act. As a shareholder, you collectively own the company, which means you bear the risks if the business fails, but you also enjoy the rewards if the business succeeds. Now, let us switch gears and look at debt instruments, specifically debentures, bonds and notes. Unlike equity, these are instruments used for raising a loan. When you invest here, you are lending money to the issuer, which could be a company or the government. You might see different terms used here. In the United States, bond is an umbrella term, while in the United Kingdom, they often use debentures for corporate debt and gilts for government debt. In India, we have a mix. We also have notes, which usually refer to shorter or medium term instruments. We also have short term debt for periods of less than 1 year, such as treasury bills issued by the government or commercial papers issued by companies. A key feature to look for is convertibility. Some debentures are fully convertible into shares, some are partly convertible, and some are non-convertible, meaning they remain pure debt until maturity. Continuing with debt instruments, we can classify them based on who issues them and where they are issued. This classification helps us understand the geography and currency of the bond. First, we have domestic bonds. These are issued by entities in their own home market using their home currency. Then we have external bonds, which are issued in foreign markets. This is where it gets interesting. External bonds allow companies to raise money outside their home country, often in a currency that is different from their own. Let us dig a little deeper into these foreign and euro bonds because the difference is quite specific. A foreign bond is issued in a foreign country and in that country's local currency. For example, if an Indian company issues a bond in the United States denominated in US dollars, that is a foreign bond. A real life example is when Delhi International Airport Limited issued US dollar bonds in the US in February 2020. On the other hand, we have euro bonds. These are issued in a foreign country, but the currency is different from that country's local currency. A classic example involves Masala Bonds. These are euro bonds denominated in Indian rupees but issued outside of India. The first Masala bond was issued in November 2014. The big benefit here is that with Masala bonds, the currency risk is transferred to the foreign investor rather than the Indian issuer. Moving away from pure debt, let us look at warrants and indices. A warrant is a specific instrument regulated by SEBI that gives you the right but not the obligation to buy equity shares at a later date for a fixed price. It is like booking a future purchase. Next, we have indices. An index tracks the movement of the market using a representative sample of stocks. You might have heard of the Nifty 50, which tracks the 50 most representative stocks on the National Stock Exchange. or the S&P BSE Sensex, which tracks 30 major stocks. We also have the SX40 for the Metropolitan Stock Exchange. These indices act as a barometer for the economy and serve as a benchmark to see how well other funds are performing. Now let us talk about a very popular investment vehicle, mutual fund units. The concept here is simple. Investors pool their money together and professional managers invest that pool into a portfolio of assets. In return, you get units based on the net asset value or NAV, which changes as the portfolio value changes. There are two main types. Open-ended schemes allow you to buy or sell units from the fund at any time. Close-ended schemes have a fixed amount of capital and are sold only for a specific period, after which they are listed on a stock exchange where they can be traded. A special type of fund that has gained popularity is the exchange traded fund or ETF. Think of this as a hybrid. Like a mutual fund, it tracks an index or a basket of assets like gold. However, unlike a regular mutual fund, ETF units are listed and traded on a stock exchange in real time, just like equity shares. The creation mechanism involves authorized participants who create bundles of assets and deliver them to the fund sponsor in exchange for ETF units. This structure gives you the diversification of a fund, but with the lower expense ratios and real-time pricing of a stock. Next, we enter the world of hybrids and structured products, starting with preference shares. These shares are unique because they have features of both equity and debt. They are called shares and dividends are paid from profit after tax, which sounds like equity. However, they are like debt because they offer a predetermined dividend rate. Crucially, preference shareholders get paid their dividends before common shareholders. In the event of the company winding up, they also get their capital back before common shareholders. However, they generally do not have voting rights. Another important hybrid instrument is the convertible debenture. This starts its life as a debt instrument, paying you a periodic interest rate or coupon. However, at a future date, it can be converted into equity shares. There are three main types: fully convertible debentures or FCD, where the entire face value turns into shares; partly convertible debentures or PCD, where only a portion converts and the rest remains as debt; and optionally convertible debentures or OCD, where the investor is given the choice to convert or not. For the issuer, this is attractive because they can offer a lower coupon rate. And for the investor, it offers the safety of debt plus capital appreciation potential from the equity. Now, what if you want to invest in foreign companies? This is where depository receipts come in. These are financial instruments that represent shares of a foreign company but are traded in a local market. For example, American depository receipts or ADRs allow US investors to buy shares of Indian companies like Infosys or Wipro on American exchanges. Conversely, Indian depository receipts or IDRs allow Indian investors to buy foreign companies like Standard Chartered in India. We also have global depository receipts or GDRs, which are often traded in European markets. This mechanism typically involves a custodian holding the actual shares and a depository issuing the receipts against them. We also have more complex instruments like FCCBs, ELDs, and CLDs. FCCBs stand for Foreign Currency Convertible Bonds. These are dollar-denominated debt securities issued by companies in international markets that can be converted into equity. Then we have ELDs or equity-linked debentures. These are debt instruments where the interest you earn is based on the returns of an equity index like the Nifty 50. They offer principal protection through bonds plus upside potential through options. Similarly, CLDs or commodity linked debentures link their returns to commodities like gold or silver, giving you a safe way to participate in commodity markets. Let us look at how illiquid assets are turned into tradable securities. This brings us to mortgage-backed securities or MBS and asset-backed securities or ABS. In this process, institutions pool together loans such as home loans or credit card receivables and issue bonds against the cash flows from these loans. This converts assets that are hard to sell into liquid instruments. We also have REITs and invitees. These are trusts that pool money to invest in large real estate or infrastructure projects. Regulations require REITs to invest 80% of their assets in revenue generating real estate. A key feature is that they must distribute at least 90% of their surplus cash flow back to you, the unit holder. Finally, we come to the fourth asset class, commodities. These are basic goods that are largely interchangeable, meaning one unit is more or less the same as another. We divide them into hard commodities, which are mined or extracted like metals and crude oil, and soft commodities, which are agricultural products like grains. Precious metals like gold and silver are a popular subset here. They are often used as an investment to preserve value and hedge against inflation because they have a long life and relatively low storage costs compared to their value. To wrap up, let us see how you can actually invest in commodities without physically storing them. One efficient way is through commodity ETFs. These funds invest in physical commodities, mostly gold, and you simply buy units of the fund. This saves you the hassle of storage. Another method is through managed futures contracts, where professionals manage a portfolio of future contracts to gain from price movements. Lastly, there are warehouse receipts. These are documents that prove you own goods stored in a warehouse. They are negotiable, meaning you can transfer ownership of the goods simply by transferring the receipt. This concludes our video on the various financial securities and product definitions.